So welcome everybody, thanks for joining us this evening for tonight's webinar. Before we start, I'd like to draw your attention to the disclaimer on screen that I'll read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorised to provide recommendations on any instrument of any kind as part of this presentation. The strategies showcased relied on hypothetical scenarios. Any instruments that are mentioned throughout are cited only for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone doesn't represent that the material provided here is accurate, current or complete, and therefore shouldn't be relied upon as such. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any listeners of this content to seek their own advice. So thanks for joining us this evening on tonight's webinar, which is called Master the Supply Shock Problem Impacting Markets. I'll go straight on to the strategy, to the structure. Tonight, so obviously there's lots going on in markets, and it maybe seems a little bit calmer, although the dollar is, trending higher this week already. But there is payrolls on Friday, so thought it would be a good time for Maurice to talk about the supply shock problem that is impacting markets and central banks, what this means for the payroll data on Friday, and how it all could potentially pan out in the week ahead, depending on what the data brings. Roger's going to talk about one of his take profit strategies, which is a zero cost strategy, and how you can make that work if that's something that you want to do in your trading, if it suits the way that you trade. He's going to then pass over to Richard, who's going to look at support and resistance principles, and he's going to use a live chart example and setup to run through, so you've got the full example in front of you on the screen as you proceed and trade markets. So I'm going to pass over to Maurice. Maurice, over to you.
Yeah, thanks, Chris. Welcome, everybody. Yeah, an interesting week. Bonds doing nothing, seeing nothing in stocks, but they sit around all-time highs. Well, I want to sort of talk about some things going on with the, as we've come out of the pandemic, where central banks got to and where they're heading at the moment. And I think it's quite an important crossroads that we're at here with central banks, because there's a lot going on. So I think what we saw was the pandemic hit pretty hard. We saw the reaction to that was basically a global shutdown. Demand for the likes of oil, I've put oil as a chart here for you just as a reference, but it hit everything really. We had what was called a negative demand shock. So there was a demand crisis, if you like, because everything shut down, people stopped driving, people stopped flying, just about everything started heading down that we sort of were normally in demand for. And then as we got into April 2020, oil got down to about $19. We then saw the central bank actions kick in. Now, the central banks were faced with a once in a generation shock to the system, and they, to be honest, acted pretty quickly and quite aggressively. Some slashed rates down to zero, some even below. And they saw this massive demand shock coming where, no spending would be taking place. The economies was literally mothballed, if you like, by governments where we weren't allowed to go out and spend. And, we saw governments move pretty quickly to offer furloughed schemes and financial help to businesses around the economy. So that was all pretty positive. And, those actions needed to be put in place, to be honest. So that was the reaction to the pandemic. Now, the result of this demand shock policy sent oil back up and the demand back up. And what we got from November 2020 onwards was what was realistically the impact of the discovery of vaccinations and the rapid sort of way that we managed to get these out into where they were needed, into people's arms. And we started to see quite a turn in economic growth. Now, this took off literally around the globe. It was led by China, and the US to a degree started kicking in pretty quickly. So too the UK, as vaccinations did very well. And we saw this move back up from oil and commodities. So when that economic growth took off, we no longer had a negative demand shock. What we had was something of a supply shock. So this is a completely different structure. Now, when policies are set for a demand shock, it is important to examine if that is the issue we are now facing. And to me, I'm not sure it is. So not only have we got all these policies in place, but we now have the fiscal spending packages coming through, particularly from the US and about to hit in the EU as well, where government spending is going to go direct into the economy. Now that's different to monetary policy, but it's an additional boost. So these economies are now running pretty strongly and pretty hot. Basically with negative rates or almost zero rates and this strong growth, one has to argue that there is no longer what looks like a demand shock out there. If anything, we have a supply shock. So where does that leave monetary policy right now? Well, overly accommodative. And the Fed and the ECB particularly seem to be happy with that at the moment. They don't seem to want to pull this back in case they damage the recovery. But what they are doing here could be quite dangerous, because the inflation genie, once it is out of the bottle, can be difficult to get back in. And raising rates with the debt amounts that we've got, I'm not sure that's an option for anybody at the moment. So if we look at what's actually in the US Senate's 1.2 trillion infrastructure plan, well, they got about $1 trillion of it passed. In fact, if we look at the rolling over of existing plans, the actual new money is about half of that. But we have seen commodities start to move higher as we saw this fiscal demand. And what we were really seeing was investors front running the idea that the governments around the world were shifting to more green energy policies. So that green agenda that seems to be out there and having political drive is driving commodities higher. Now, if some of these big packages get passed, there is a danger that those commodities stay elevated, which means prices feed into consumers' demands again, and therefore inflation could rise. In addition, we are hearing of labor shortages. We've had a lot of furlough schemes and they've been reluctant to come back because in some of these schemes, they're earning more for being at home than they are for being at work. So the other thing is that the labor shortages, a lot of people have decided to change their structure. They've decided to leave the workforce altogether. In the UK, we've got a Brexit issue where foreign European workers have been forced out, and those guys are not coming back. So to attract people to those jobs, wages surely are going to have to rise. Again, a potential inflation drag there as well, because higher wages can impact. So stocks, however, seem to be looking through all this because they seem to believe that the Fed is going to be slow to move. And whilst we sit at all-time highs here, look at this S&P chart. We saw those dips. We saw a nasty dip down in June on sort of comments from some of the central bankers. This inflation issue has split the Fed, I think. There are some of these guys out there, particularly after the 16th of June meeting that we saw. We've seen Fed speakers come out since then and suggest they are worried, but the Fed, Powell in particular, was pretty adamant that inflation was still transitory. And that's when we got that pop back up again from 41.37 back to the 42.88, 42.95 all-time highs that we see now. So, that mid-June panic was on the belief that there was a danger that inflation was becoming a problem. And then we go and get people like some of the Fed speakers suggesting they feel it is a bit of a problem. So, at the moment, I think the markets believe Powell, and that's why we've got this liquidity issue still holding up these markets. So, in these markets, we would normally expect tightening of policies, but I think the Fed and the ECB in particular are extremely reticent to do so in case they feel that they stop the growth in its tracks. And obviously with so much debt around, it is difficult, with all the spending that's going on from Biden and the EU governments as well. It's very difficult to raise rates when those central banks are literally trying to keep rates down so those governments can borrow cheaply. So that's the sort of dilemma we have, and this is why the Fed has decided to tag its policy to what are lagging data, as in unemployment. But I think what we need to do is ask ourselves a question: is do we actually need interest rates here set for deflation, low growth, and a demand shock? And I'm just not convinced we do. Jim Bullard's been out a couple of times saying he actually expects the first interest rate not at the end of 2023, but in 2022, and a couple of others have said the same thing. But again, markets seem to believe, well, at least the stock market does. Now, interestingly, we have a dollar rising at the moment, and I think some people may be thinking the Fed might have to move. So this split is going to be very interesting. The discussion is probably going to be quite heated, but we've got a little time to wait for the next central bank meetings from the US and the UK. The UK one not until August the 5th. But I think some of these splits are going to start coming a bit more public, and markets, I think, are beginning to suggest maybe the Fed is going to be a little bit more hawkish, and I think that's why we're seeing the dollar rise at the moment. But at the moment, stock markets don't believe it. They're still very keen to sort of take the liquidity. They believe that any tapering will be in advance from now, possibly even into 2022. And they don't see the liquidity falling away. And let's face it, global equity markets, and particularly US equity markets, are here because of liquidity, not much else. And that's why whenever they threaten to take this liquidity away, stocks fall. And we've seen these falls before, and we've seen them back. But this whole idea that they are going to hold themselves and their policy based on unemployment is a real issue here. And it also brings into focus Friday's non-farm payroll data. It's going to be extraordinarily important, that data. We've had a couple of disappointments, but I think we're due a big one. It has improved, but it's underperformed expectations. That's what's key here. So whilst the Fed wants better results, what we did see last time when we got weaker data, that's worse data, if you like, stocks actually rallied. And that, again, highlights that they're more interested in what's going to happen in liquidity than they are about whether the economy is actually getting better. So I think that's really interesting, because we've seen the same move in the dollar. We saw the dollar sell off before. The weakness in the data sent the dollar down, stocks went up. Interestingly, what we're seeing right now is we're seeing a stronger dollar with stocks holding up. Now, that's unusual. And also the dollar is strengthening with bonds doing nothing at the moment. That's also very interesting. So the dollar's now bouncing. So you can see the euro starting to fall again. I think this month's payrolls are going to be really important, because I think there's a lot of the furloughed workers are now heading back. I think an awful lot of benefits are stopping. I think 22 states in the US now have stopped their job security funding. And I think people are being forced back to work. So we could have a big number here. Payrolls at the moment expected around 675 to 700. I'm hearing 5.6, 5.7 on the unemployment rate. I'm hearing, if we get a big employment rate change, if we do see a 5.5 print or something like that, I think that's going to be really important. But I think what we need to ask ourselves is, what does a strong print mean, or what does a weak print mean? Now, at the moment, I think a strong number means there's more likelihood that the Fed may taper early, and I think that would be a liquidity issue for equity markets, and I think that would see equity markets down. I also think, because it would look like the Fed is going to be one of the first major economies, central banks to move, I think that would be positive for the dollar as well. So, we're already seeing the dollar move. What we haven't seen is the equity move, and I think equity markets and bond markets are definitely waiting for Friday's data. On Thursday, we also get initial jobless claims tomorrow, and we also get ISM, which has got an employment component in it. So all very important leading into that big Friday number. So I think it's going to be quite a fascinating end to the week. I think it's a number that matters to everybody, and particularly the Fed. So, if it is a big number, look out. If it's a big miss as well, look out. But I think we need to understand what good news may be bad news and bad news may be good news. It sounds weird, but that's the way it is, because it's based on liquidity, not the strength of the economy. On that note, that's me done. I'm going to pass over to Roger, who's going to talk to you one of my favorite ideas about taking profits and a zero cost strategy. Rog?
Cheers, Mo. Great stuff. And always key to be on top of this stuff, because, as Mo quite rightly said there, some of these correlations flip as themes change, and, you need to be on top of that game. So tonight we're going to continue with our take profit strategies and introduce zero cost strategy. This is a great trade to get in. I would say, particularly if you're a bit inexperienced, or you're not yet quite getting to grips with holding risk. And so we'll hopefully this will appeal to some of you, but maybe not all. To really frame the debate here, I need to go right back to the real fundamentals, and that's not a bad thing to do on a regular basis, just to reaffirm the disciplines that really sit behind successful traders, that makes sure you have structure behind everything you do. And the key here is longevity. We want people to still be trading in 2 years' time to be successful, and without these fundamentals, it's simply not going to happen. So it of course is that simple concept that every time you put risk into a market, it can go against you and you can lose money. So, we need to make sure we've got some form of protection in the markets. And as we've been talking over the weeks, the way we try and teach and structure our trades is making sure that protection is at relevant levels and it's affordable. And by affordable, I mean affordable on an individual basis. We all have different budgets and we all have trading styles that should relate to that budget. So that protection comes at a cost. We know what that is because we put our stop losses in, and as I said, we put them in at relevant and affordable levels. Clearly then we're looking at where we want to take profit, and I know sometimes this is a moving target, but we have to have some degree, some idea of where our markets can go to and where we'd be comfortable taking profits. And so that simple trade-off is that risk reward that we talk about. How much are you prepared to lose to make X? And in this instance, we've got those simple numbers of an entry level at 6,850. You take your stop loss down there at 6,750, so that's 100 ticks, and you're looking to take a profit of 200. So you got a positive risk reward of 2 to 1, i.e. for every dollar you're prepared to lose or pound you're prepared to lose, you're trying to make 2. And if this isn't an exact science, we're not always looking for 2 to 1. But over a series of trades, trying to get to attempt a positive risk reward will give you that longevity that we're looking for. So with that comes the question: is can we get to a point where we actually give ourselves zero risk? Can we get our entry level down to where our actual protection is? And that's what we're going to try and discuss today. So, one of the important things, as I've got on the bottom right there, is this is just one strategy, in a suite on the left-hand side of potential take profit strategies. So we're not suggesting people adopt this or do it on every single trade. It should always be relative to market conditions and price action and your own style and what you want to achieve out of your trading. But it is certainly something that I think people should consider. So what are we trying to achieve out of this strategy? Simply to improve the average of our entry level, so that if that trade were to go wrong, basically where we get out is the level where we are actually entered into that trade on an average basis. So effectively, if the trade goes wrong, it costs us no money. And clearly, I think we all understand that will be a great place to be. So as ever, we look at the considerations on this, and one of the key things here is obviously to achieve this, we are taking some risk off the table to get that zero cost transaction. So by definition, that means the upside potential reduces as well, but it will give us most definitely a positive risk reward, which is what we're also trying to achieve. So we're just going to go straight to the charts now, I believe, and we've got a market here. It's a cable market, sterling versus the dollar, and we're just going to literally go through the basics. We've got an entry level, and what are we trying to do? We're trying to improve that average. So there we enter at 138.45. How can we get that entry level down to where we've got our stop loss? The key things and the fundamentals that we obviously want to put here and make sure we go through our process. We've got that entry level at 138.45. We've got the low of the day at 138.10. We could put our stop loss there. You know, it's a valid level, but we may actually feel that's too tight, and therefore we want our stop loss a bit lower. What's the next thing we must do? We must try and find the next relevant level. Let's not just put our stop loss in the middle of nowhere, because we could get stopped out unnecessarily. Let's find the next relevant level. In this instance, we've got the Fibonacci 38% at 137.75. So as always, we put our protection on a stop loss on the downside below that. We don't put it exactly on that level. In this instance, we've chosen 137.60, but again, that's not an exact science. We want people to understand the markets they're in, and if they feel 10 points is the right slippage before your stop loss, then that's where it is. You know, it's an individual decision, but certainly it has to be below that 137.75 level. So we've got this trade on, and we hope it starts working for us. The market does move in our favor, and in order for us to try and get our average trade down, so we've bought 10 units, £10 per point at 138.45. The market moves up. We've got a nice instant profit now. Now, of course, we could sell everything out, but that's not what we're discussing today, but it's always an option. So in order to try and get to zero cost trade, in this instance, the market's moved up, and we think, you know, why don't I sell £3 worth of my position out here? I'm selling 30% of my risk at 138.90. I can nickel and dime 45 ticks there. And yes, we're making a profit of £135, but the simple fact that that goes into your pot as such, it will reduce the average entry level. And as we see here, pure maths, if I buy 10 at 138.45, I sell 3 at 138.90, the average rate for the £7 per point that I have is now 138.26. So, but as we said, you know, that comes with some downside in as much as my risk is reduced, and therefore if I still have my take profit level up there at 139.85, my actual profit is reduced. On the previous part of the slide, our potential profit to start with would have been £1,400 if I remember, versus a loss of 850. That's already a nice positive risk reward, but as my potential profit now is reduced because I've got a smaller size position in the market, it goes down to 1113. But similarly, I've moved my average closer to my stop loss, so my loss also is reduced as well. So what I've actually done by doing that is actually put myself in an even better positive risk reward scenario, from a fraction under 2 to 1 to now a fraction under 3 to 1. So the way we like to view our trading is that everything we're doing so far is positive. It's good psychologically, and it's good from a risk perspective as well. So we then let this trade progress, and very fortunately, it moves in our favor again. And, you know, what I would do if I was in this situation, I would absolutely have a review of my risk when I see a nice sharp move like that. You know, that even means people have just jumped on board and started reaching for offers to get long. And, you know, my mind is, you know, I wouldn't mind taking advantage of some of that. And bear in mind, I'm actually setting myself out. I like the concept of getting a zero cost trade. So I'm going to sell another 3. And I'm going to sell them up there at 139.15. And, you know, similarly, from a maths perspective, yes, I'm reducing my risk. So I only hold £4 per point now, but I've actually got my average down to 137.60. Now, again, this is not an exact science. You shouldn't be selling at an exact level to try and achieve an exact, you know, stop loss protection. You know, give or take 50 quid, 100 quid, you know, give or take a couple of ticks around those levels. That's what you're trying to achieve. We're not trying to look at exact numbers. It's just that we've done it that way for this showcase. So similarly, as we've done before, by doing this, by getting ourselves into a lovely situation that if the market goes wrong, I lose no money, I'm going to lose potential upside. But, you know, I'm not going to cry tears if my downside is 0 and my upside, even though it's reduced, is still £900. I like that concept. And that's effectively what we're trying to achieve. So we can then play that market out. Again, fortunately, it runs in our favor. We get up to that 139.85 level. Our initial concept was to take profit up there. Again, in this instance, that's what we're doing to prove the concept of this strategy. But you could, of course, take a rain check up there, have a look at the market, see what's driving it, and you may even stay in that position. And then you could get into the other concepts of trailing stops, you know, really ride that trend. So lots and lots of opportunity here, but just for the sake of this 0 cost, that's where you take your profit. You're now square. You've made £900 throughout that trade. Psychologically, emotionally, you've been pretty stable, or you should be, because you've never put yourself under pressure. And, you know, I think certainly in those early days of people trading, you should be trying to get yourself into these situations. So, you know, pretty much every time you trade, you have the ability to just take profit and have very, very limited loss. Now, of course, as we said right at the outset, this is just, you know, one of a suite of take profit strategies. There could be, you know, people that look at this and think, wow, you know, I really want to get on board with this. But there will be others with a different trading mentality that, you know, once they sold that first tranche and the market moves up again, it's constantly on their mind. They've kind of got seller's regret because they've sold and it's gone higher. And there may be some that feel by just selling out in pieces, you're under leveraged when the market moves in your favor. And I fully understand that, and that's something that, you know, hopefully we've got some other strategies that will come forward for those type of traders. But, you know, for me, I tried not to box myself in with just one type of strategy. For me, markets are different every day. So, you know, I don't never ever feel on every single day I had to be at full leverage. There were days where the markets just didn't suit me, didn't suit my mentality. And so, you know, one of the key things we're trying to introduce over these weeks is some flexibility. And of course, the final word of warning, markets don't always go in your favor. So, you know, under our strategy, if we'd have managed to get ourselves to that 139.15 level, got ourselves into a 0 cost, when the market turns in our face, which they can very regularly do, this trade has cost me nothing, because I adopted that style and that trading strategy, and I got away with one. That's the way I would look at it, because I was a bit smart, maybe a bit cautious in some people's eyes, but I was also pretty smart. If you're one of these people that are always fully leveraged, you don't believe in this kind of thing, in this instance, you're going to take a big hit. And whilst you may say, yeah, but I could have held all the way through with my whole 10 units up to 139.85, of course you could have done. But one of the key things about longevity in trading is avoiding the big hits. You know, the more of those big hits, you know, you may get 7 out of 10 right, but if the first 3 of that 10 are all wrong and all 3 of those are big hits, psychologically, that's going to make you trade differently on those final 7. So, you know, things don't happen in straight lines. Your successful trades aren't always the first ones. So, you know, just bear that in mind. And again, just think of this one as one potential strategy in a raft of strategies that we're going to provide for you over the next few weeks. That you can adopt it when you feel the market's right for you, in terms of volatility and actually the risk appetite that you have on any given day. So hopefully that helps, and I'm going to hand you over to Richard now, and as ever, going into live examples, you know, to showcase some of his skills is never a bad thing. So over to you, Richard.
Great, thanks very much, Rog, and very interesting as always, and obviously very important to know how to structure the trades and when to move stops and protect your position and to actually be aware of these techniques when actually adopting that within a day-to-day trading strategy. What I wanted to do this week was to, in some ways, go back to the basics, if you like, and look at support and resistance principles within technical analysis, because if you like, you know, this is the most basic idea or theory within technical analysis that we can look at, but it is very important to actually understand the reasoning behind why and support and resistance develops, and what to expect if we start to see levels being broken, and what sort of sentiment measure we can take from how the market's trading, and the relationship between the highs and lows within price action. And so we'll look at that this evening, and then we'll just look at the basics to start with and recap over things that you may be aware of, things that we may have spoken about before. But then look at a live example of a trade that I actually did this week in terms of looking at gold and how support and resistance helped me establish where the risks were building, and effectively, you know, when to actually pull the trigger on a trade, rather than just sort of trying to preempt breaks of support and resistance levels, to actually sort of wait for the trigger to develop and to give me that feel for how the market's trading. Okay, so what is support and resistance? Well, basically, support is an area where the market sells off into and runs into buyers. So it finds buying support or demand in terms of price activity. And when there's more demand than supply, so there's more buying than selling, prices will rise. So the sell-off within price action comes back towards a level where we run into buying support, buyers become active within the market again, having used weakness as a buying opportunity, and that fresh demand begins to outweigh the selling pressure that we've previously seen, and prices within that demand backdrop begin to rise once more. Now, as we approach the previous high from which the market has encountered selling pressure, and the market has basically rejected and sold off from this point previously, that will automatically, within our minds, become a potential resistance focus. So in other words, it was a level where sellers were active previously, and until the market proves that they're not still active at that level, then it will act as a resistance point, and the potential would be to turn lower once more as selling pressure begins to materialize. And then the mirror image develops as we start to trade back towards the support level where previous buyers have developed. So this will continue, this type of more balanced trading activity will continue with a consistent selling level to the upside, a resistance point to the upside, and support to the downside as the buyers are evident and active at lower levels, and the sellers are active at higher levels. And as long as that selling and buying support, supply and demand pressure continues to materialize, then the market will trade within this sideways trading range between the support and resistance levels. Now, at this point, we don't actually know how the market is going to break out and in what direction that's likely to be seen. So we can either trade the range, so in other words, we're looking for this support to continue to hold, and we're looking to go long against this previous low where buyers have been active previously, and the market's rallied back towards the resistance point. And if we're trading the range, we look for the resistance to continue to hold and the market retreat and sell off, having tested this area. So in that position, we're trading the range, we're looking to take a reasonably quick profit on longs against the support level and profits against shorts, looking to establish shorts against the resistance point, reversing the position from long to short, looking to continue that range. And that range will continue until we see a breakout. So our stop will have to be below the previous support points or above the previous resistance levels in case we start to see a breakout occurring. Now, the beauty of that is that obviously having gone long against the support level, your stop is relatively close to price activity. So we would have to sort of break lower under these supports to trigger your stop, but it wouldn't be significantly away from your trading level. So you would be more aggressive with your stop. You could even have larger positioning because you know that your stop point is close to your entry level, be it against the support or the resistance. Now, an important factor within this sideways trading range is the supply and demand vacuum. And this is important when it comes to placing your stop, because the longer the support and resistance levels remain, as long as the sideways trading area within markets continues, if you're looking to buy the market just under the previous support point or sell the market just above the resistance level, you become frustrated in that you're not being active within the market. You're not trading, you're not being able to take profit on long positions against the resistance or profits on short positions against the support. So you will lower your sell orders and raise your buy orders to just below the resistance point or just above the support point, so that you then become active within the market, and you then are taking positions looking for this range to develop. Now, of course, the more people that lower their sell orders and raise their buy orders, the more significant the range will become, and the longer we'll see the market trading within this sideways range. But importantly, having seen the sell orders lowered to just below the resistance point and the buy orders that weren't getting activated raised to just above the support level, we actually then see an area within price activity above the upper limits of the range and below the lower limits of the range, where there are effectively no orders active within the market. So because they've all been pulled lower into this trading range to extend it. So the longer the trading range goes on, the more significant the supply or demand vacuum, or the area where there's no offers above the market or no bids below the market, becomes. And this is why we see an acceleration when we break out from this sideways trading range, because the market will then automatically move to where the next buy order is to the downside once we've broken lower, or the next offer is, and then we encounter resistance above the price activity following the breakout from the range. So it's very important to be aware of this supply and demand vacuum when you're placing your stops. You need to be aware that this is a phenomenon that could actually see you filled at not as a good level as you might expect. And so you need to be aware that this acceleration phase can develop from this sort of trading range. Now, if you're waiting for the breakout to buy the market, then again, you need to be aware of the risk of the market accelerating sharply higher to bring about a move following the breakout. Because again, if you're trying to be very quick in terms of activating a long position on the break to the upside, the fact that the supply vacuum is in place may mean that your activation point where you go longer the market may well be some way higher because the market is accelerating. And you need to be aware of that type of phenomenon within a sideways trading range. Now, when it comes to uptrends and downtrends, this is where we haven't got balance within price activity that the sideways trading range represents. Within an uptrend, we have more dominant buyers against sellers. So in other words, sentiment is more bullish because traders are happy to pay higher levels each time the market sells off to get long of the market. So in other words, it takes less of a correction to run into fresh support and then the market breaks above the previous recovery high and starts posting the basic definition of an uptrend, higher highs and higher lows. So the uptrend, once we're still seeing this pattern of higher highs and higher lows, whether there's a straight line connecting the lows or not, you're still looking at positive sentiment and the market trading in more bullish themes. So as soon as we take out that previous high, we have confirmation of further extension to the upside, the market continuing to see buying support until we start to see short-term profit taking, the correction develops, we again run into buyers at higher levels above the previous correction low, from which we then rally and break above the previous high, and we break resistance and extend the bullish pattern. Now, the trend line break isn't that significant. It highlights that something is changing within the market, but what I would stress is that if you see a trend line break, such as we have in this example, the actual break itself isn't a signal to go short of the market. And by this, I mean that it may well be indicating the potential to change direction, but we need to see further confirmation of this trend change. And that would be a break below the last correction low of the positive trend. So in other words, in this example, the trend break actually saw us sell off a little bit further. So it reflected something changing within price activity. So we may well have had our stop under this trend, but that would just then take us flat and we would then see what happens. If the market then rallies back and fails above the previous recovery high, we have what's called a weak test of the previous high. And then if we then sell off and break below this last correction low, we then effectively have a bearish trend, a pattern of lower highs and lower lows in place. So it's important to be aware of these support levels and resistance points within price activity, and then just see how that develops and whether or not we see this weak test, because more often than not, you will see a rally back towards a previous high and the market will sell off, will fail, sell off and break this last correction low to reflect a more negative sentiment shift and the risk of a deeper sell-off. So when we come to look at support and resistance levels, it's quite important to keep that in mind. So what I'm going to do now is flip across to the live system, if I can, Chris, and we're going to look at gold on an hourly basis. Now, those of you that were with us on the Sunday night webinar will know that I was highlighting a sideways trading range within gold as of Friday's close. And we were looking at the support levels offered by the recent lows, because the market had sold off a number of times to this point and rallied sharply. So in other words, we had confirmation of this being a support point. Now, the resistance focus was this previous high, from which the market had obviously rallied into, sold off aggressively, and each of the rallies had failed to break above that point. And we've represented the resistance by a downtrend connecting these highs. It's not quite the same sort of sideways trading range that we were looking at earlier, but it's certainly an indication of more balanced trading within gold and the risks of development of these sideways moves until we see a breakout occur. Now, my view was very much a matter of, well, we need to see the breakout developing gold to really suggest where the next directional risks are. Now, I'm happy to sit on my hands, not trade within this market, look for other opportunities elsewhere, and only become active in gold once we start to see the breakout beginning to develop on a closing basis. So we're looking at an hourly chart here. I would like to see an hourly closing breakout to confirm any breaks to the upside or to the downside. Now, as the week began, we actually then saw a very early on Monday morning test of the old lows again. We did actually nudge below it, but we managed to rally, and we didn't see an hourly close below the trend line support. Now, obviously, we would have been sort of asleep in the UK at this time. It's about 2 o'clock in the morning in London time. So it's more a matter of reassessing what has actually happened within price action when we wake up and become active within the market again. Now, as you see, what actually happened is the market rallied from this area and extended the sideways trading range once more. However, we start to see a failure and selling pressure beginning to develop once more, and we again approach the support level, but we see a rally. Now, you could call this type of price action a weak test of the previous high. So in other words, we're seeing failure of strength at a lower level each time. And from a sentiment perspective, that tells us that sellers are happy to wait for less of a rally before they become active in the market. And this is why we're seeing the pattern of lower highs developing, because sellers are active at a lower level each time. That reflects negative sentiment and the potential of a break of lower support, but we would still need to see the closing breakout occur to really confirm that move. So as trading activity continues later on Monday, we're still effectively within the sideways trading range. We then enter Tuesday's trade. So what the market actually then does is see the selling pressure, the break once more below these support levels, the lower limits of this sideways trading range, and we then see that acceleration to the downside as that demand vacuum came into play. And this move happened very quickly. It accelerated very sharply within this 1 hour period, and we saw the market sell off and actually confirm the break lower. Now, it's very tempting to sell on a break of a trend within this first hour period. I rather would wait for confirmation of the hourly close, and then often you will see a recovery back towards the old support level. So in other words, we see a pullback to the old support, which then becomes resistance. And I actually use this rally the next hour from the breakout as an opportunity against this resistance area to sell the market, go short, and look for the opportunity to develop more negative themes. And what actually happened was that we saw a very aggressive sell-off developing within this hourly period where the market attempted to rally. My stop was above this last recovery high because it would then break the pattern of lower highs, and the market rallied up as the pullback developed, but you can see that we failed very quickly and sold off aggressively and saw a very sharp acceleration to the downside. Now that may be another indication of the demand vacuum at lower levels, but in my view, it's more a fact of a retest of resistance from which it failed. And then we started to see more significant selling pressure beginning to develop again. And we've seen further downside developing. And within today's trade, the market has rallied back and retesting this resistance level, lo and behold, and we're starting to see selling pressure again. Now, my stop was actually pulled down, having seen this pattern of lower highs to just above this point. So I was stopped out earlier today, but obviously still had a reasonable profit. And if you'd wanted to take a smash and grab trade, as Roger likes to call them, then obviously this sharp acceleration back towards this low, it may well have been tempting to actually close the shorts on that trade. But I was taking a slightly longer term view. The market then stopped me out and we rallied back to this resistance. And for me, this is again a potential failure zone to resume what is still within the daily picture, a more negative basis. So this is the daily, so each of these bars is a daily, and you can see that the latest consolidation we've broken lower. Today's recovery still seems to be just a pullback towards the resistance of this sideways trading range, from which we can see more selling pressure, an extension of this more negative pattern of lower highs and lower lows. So by using support and resistance levels, you can get a feel for the important trigger points. You can also see how the market's trading. Are we failing to break previous highs? Are we seeing sellers active at a lower level each time? And if we are, then that reflects more negative sentiment and the potential to break lower. We would still need to see that confirmation, but once it's established, then that is certainly an indication to develop more negative themes and the risk of trading opportunities, having broken those support points and seen consistent failures of recoveries to break above the previous recovery highs, maintaining the negative sentiment within the market. So that's looking at support and resistance within sort of intraday trading perspective. Just take a look at the charts and you'll see how these patterns form, the sideways trading range, the breakout, the supply and demand vacuum coming into play, and just seeing how the market's actually trading in terms of a trending condition and what that's likely to mean for the sentiment aspect within the market. So I'll just hand back to Chris now, who's going to look at your questions. Thanks very much, Chris.
Thanks, Richard. Thank you, Morris. Thank you, Roger. Some great stuff tonight. While we've got that chart up, Richard, what obviously you're saying that it doesn't feel like the potentially, that it still feels like the bias is potentially to the downside. What do you think's the next major support looking on these charts that you would, what are the levels that you're looking at?
Yeah, that's a good point. I mean, to be honest, we're holding on this previous low, but the fact that we're breaking lower from this type of pattern really means that we should see that point give way. And to be honest, the more significant support levels are really the old lows, the level that we saw sort of around about the 1675, 80 type area, I think, offered by these lows, which is a support point. And if we do see acceleration, then I think that we should hold on that point, having seen both occasions prompting a sharp rally. Now, if you wanted to see a good example of a weak test of a previous low, having seen the rally, then obviously we sold off fairly aggressively, but we held around this low. We then rallied and broke above this previous recovery high. So we then started to see more positive themes developing. So that's another reason for looking at these lows as being a potentially strong support point. And if we do start to see more acceleration to the downside, I think that's certainly likely to be the next point that could sort of prompt attempts or more serious attempts at a recovery as a reaction to this sharp sell-off.
Okay, thanks very much. Now, focusing on gold, Morris, what do you think the reasons are for this such a sharp retracement in gold, in the month of June?
Quite literally down to the rise in the dollar. I think all metals got hit pretty hard, even silver, some of the base metals, some of the all the precious metals, and the dollar does matter to commodities. They're priced in dollars, and they took a hit. And I think the market was getting bulled up on gold as well, so I think there was positioning in there as well. But I think the main factor was the stronger dollar, Chris.
So when you say position as well, do you think that is it because it's sorry, because it's a smaller market, and this is the big door, little door that Roger always talks about? Is it because it's a smaller market, when people get out, they really struggle to get out and they rush to get out that exit door?
Well, gold's got a fair amount of liquidity in it. I wouldn't say it's one of those ones that's really tough to get out of, but when it does go, the market got pretty bulled up on gold when we went back up towards those highs. I think there was a lot of people late to the party. That's the issue here. And then I think stops rolled on top of each other, and it was self-fulfilling sort of thing. So I think that, but I think it is not as deep as the foreign exchange markets, that's for sure, by no means. So that's a valid point. But I think people were late to have the position on, and therefore were vulnerable. And I think the steepness of that fall shows that. But I think overall, the thing that triggered it all and that kept pushing against it was a higher dollar, which again we've seen today.
Okay, great. So just before we go on, there are a few more questions. I'm just going to do a bit of the housekeeping. So somebody was asking, obviously these webinars are only every 2 weeks, so fortnightly, but we do, just to highlight, we do a Sunday night webinar that Pepperstone provide for their customers. That's every Sunday night at 7 p.m. The next one is the 4th of July. If you do register, then Pepperstone, even if you can't come on the webinar, Pepperstone will get a recording that they can send you, and that will lays out everything from how we ended, how we finished the week before, and obviously with payrolls it will be a big finish to this week, I'm imagining. Anything new from the weekend and looking at the week ahead, and there are things like the RBA and things like that next week. So I think it's quite important. That is every week. So that's one of the webinars. If you want some help on your trading week or don't want to miss anything, then obviously all the mentors, Richard and Morris, put everything that they think is relevant into one 40 minutes of webinar, and then we have 20 minutes of questions. So invites for that go out every Thursday, so please join us there. Other questions that came up, somebody was asking, can you sell fractions of positions? So can you sell 0.1 of a position? So I think you can definitely sell or trade in fractions of positions. Obviously every market's different, and so but you'd have to check that. But definitely you can sell fractions of positions, so that's something that you maybe want to consider. Another question, Maurice, one for you. You said on the Sunday night webinar that we were just talking about, there was potentially some quarter or month-end rebalancing this week. Do you think it's had a significant impact on the market at all?
Not a great deal. I was quite surprised at this. There may have been some dollar demand. We saw a little bit of a dollar bid into the afternoon today. We saw a little bit of a bid into bond markets, but stocks didn't move. So I was quite surprised at that. It was a very minor shift. Whether the dollar buying had been the days before, I'm not sure. I don't think it was. But certainly the impact on equities has been absolutely minimal. The bond market move is a bit strange, so I think that may have been something to do with buying to rebalance. I think there was some buying of bonds, but to be honest, it was a very quiet one, considering these quarter ends are usually far more volatile than just the month end ones.
Okay, great. You was also talking about on the Sunday night that you highlighted that the potential lockdowns in the Sydney area. It seems like I think most of Australia now is. I was seeing some headlines today that 80% of Australians, about 20 million people, are in some form of lockdown. Do you think this is having some putting some downside pressure on the Aussie?
It's a very valid point, Chris. Yes. In a nutshell, I think that the danger is that the Aussie was holding up quite well, and then all of a sudden we got this news that we were seeing further lockdowns. They're trying to keep the Delta variant out. It seems to be in. They are extremely worried about it, and I think the market suddenly realised that this could have an impact on the RBA next week, and they're expected to be slightly more hawkish, and this could dampen that quite a bit. So I think the Aussie led some of this. I mean, both sterling and the Aussie were weak early on in this week, and it seems to have dragged a few others with it as well. And it's taken the whole broad dollar higher as well. So yes, I think that's absolutely relevant, and markets are very sensitive to lockdowns coming back. So anyone that, if you see anywhere start to lock down again, it's probably going to be a negative for the economy, and therefore I would think a negative for the currency.
On that note, obviously everybody's running scared of the Delta variant. Do you think it's a real major issue for markets? Could it impact stocks more?
Yeah, I mean, I think it depends if economies have to lock down again, Chris. We've got the Delta variant in the UK, but they're suggesting that the double vaccination is strong enough to keep that at bay, and that yes, we may have to live with this going forward, and a bit like we did with the flu. So I think people are keeping an eye on the death rates, which are quite low from it. There is a big infection rate starting to kick in again in some places, but I think the key to all this is lockdowns. If we get more lockdowns, I think it's a negative. If I think governments are going to start getting used to sort of living with this sort of thing, that it may not go away, and it's something that's going to be around, and we are going to have to be getting used to it, really. So again, it's about the death rates, and it's about whether economies get locked down or not. And some are deciding to lock it down, others are saying get on with it.
Okay, and on that note, we'll leave it. Thank you very much to the mentors. Thanks for the great questions, and thanks for attending tonight's webinar. We will see you again either on Sunday night, or we'll see you in 2 weeks' time, where we'll have more great content from the mentors. Okay, all right, all the best. Happy trading out there. See you soon. Bye-bye.